Welcome to the Trading Trek webinar series. Thank you for joining us today and making Moomoo part of your trading journey. My name is Deandra Weldon, and I am the U.S. Events Marketing Manager here at Moomoo Technologies, Inc. This series is focused on addressing some of the most commonly asked questions about the Moomoo platform, while also sharing our experts' knowledge during your trading journey. Today's webinar is all about order types, the 6 most common order types, their pros and cons, as well as how to navigate the Moomoo desktop platform. Now, before we get started, just a few quick housekeeping items. You will notice that everyone is on mute and you cannot unmute yourself, but our live chat is ready to go for you. And we do have our licensed professionals standing by to answer your questions. So please utilize that function so that we know what your questions are and can address them as quickly as possible. We will also be doing 2 live polls, so just give us a quick answer. We'd super appreciate it, and that way we can get those results posted to you right away. At the end of our presentation today, not only will you see links to more information on our Moomoo website, as well as our customer service email address, but you will also receive a link to a survey. We would love your feedback as we continue to build out our Trading Trek series, because it's really all about what you need to know for your trading journey. So let us know what future topics would be helpful, how best we can utilize this time for you so that we can really meet your needs. Thank you again so much for joining us today. Now it is my deep pleasure that I get to introduce Mr. Jacob Roth, our Senior Market Operations Analyst with Moomoo Financial Inc. Jacob, the floor is yours.
Thanks, Deandra, and good afternoon, everyone. As she said, my name is Jacob Roth, and I work on our market operations team, handling a number of our trading functions. And today we're going to explore the different order types and how they can be used on our desktop platform. As traders, as investors, the choices we make when we're executing our trades can impact our overall success. So we want to make sure we understand these different order types, and it's important to make sure they align with our investment goals and risk tolerance as well. In today's session, we'll be covering a range of order types. Each can play a different role in our trading strategy, and each offer different pros and cons. Looking forward to doing more of these with you in the future, but our aim today is not just to learn, but to understand how we can apply this knowledge practically using our trading platform to illustrate these concepts in action. So let's kick it off by diving into our first order type, the market order.
The market order is widely considered one of the more common and basic types of orders. It can be used to buy or sell a security at the next best available price during market hours. The biggest advantage with a market order is speed. In most scenarios and with most securities, your order will typically be executed immediately. But the con with a market order is that it doesn't guarantee the price you'll receive, and your order may be prone to market fluctuations. Let's take a look at our desktop app here, and say for example you currently hold an Apple position. You could look at our news tab here, and maybe you see some articles that are coming out that could have a negative impact on Apple in your opinion. At the same time, maybe you're looking at some of the fundamental analysis that we put out there, and you think some of the projections aren't a positive outlook for the stock. So let's say in this scenario, what you decide to do is sell Apple immediately. What you could do now is take a look at the current bid and ask of Apple. Really what this means is the current highest someone is willing to pay for the stock and the lowest someone is willing to sell the stock for. So again, if what's most important to you is to sell Apple immediately, what you could do is make sure you choose market in the order type, have Apple as the symbol, choose the quantity that you want to sell, and then press sell. Once you take a look at your order confirmation and confirm the details and press OK, this order would be sent to market, and during market hours, it should and could fill immediately. So again, The market order is most used when immediate execution is most important and not price. Next up, we are going to look at limit orders. This order type allows you to specify the price at which you're willing to buy or sell a security. So the biggest pro with a limit order is that it gives you control over execution price. This makes sure that you don't pay more or sell for less than you're willing to accept. But the con with a limit order is that it doesn't guarantee execution. So if the market never reaches your specified price for your order, it will just never be executed in that scenario. A buy limit order is typically placed below the market price, and a sell limit order is typically placed above the current price. So let's take a look at our desktop platform again. Moomoo allows you to designate between sessions and choose whether you want your order to be live only during regular trading hours or regular trading hours plus the pre and post market. You're also allowed to choose time and force. So you can choose a day order, which means it would only be good for that one day and that session that you choose. Or you can choose good until canceled, which means your order will stay open for 90 calendar days. Let's say, for example, you want to buy Amazon shares, but the highest you're willing to spend for a share is $165. What you can do in this scenario is make sure you choose limit and set your price for $165. Choose your quantity that you're willing and able to buy. And once you press buy and confirm your order details, you can then hit OK. And at any point during regular trading hours in the next 90 calendar days, if someone is willing to sell you Amazon for $165 a share, then your order can be executed. If the market price never hits $165 per share, after 90 calendar days, your order will be canceled, but you can also choose to cancel or modify your order at any point during those 90 calendar days as well. So again, a limit order can be used when price is most important to you, but guaranteed execution may not be. All right, next we are going to talk about two closely related order types you have at your disposal, stop and stop limit orders. These orders can be used on the sell side to potentially protect you against losses or lock in profits. They are typically less used on the buy side, but these orders can also be potentially used to trade technical breakouts as well. The most typically used form of a stop order lies in its ability to provide an exit strategy. You may have heard this described as a stop loss order in the past. So again, whether you're looking to prevent a steep loss or secure accrued gains on a position, these orders may be beneficial to add to your trading strategy. With a sell stop order, you can choose to place an order below the current market price. And if the price of the stock moves downwards and hits your designated trigger price, it will send a market order for execution. A con of this order type is that it is prone to gap down scenarios. So let's take a look at our desktop platform again. And say, for example, you are trying to use our market position overview to help identify potential resistance or support lines in Tesla. So in this scenario, what you may be thinking about if you already own a position in Tesla and identify support as around $174, what you may think about doing is placing a stop market order on Tesla. Let's say you own a position of one share, and again, you want your trigger price to be $174. What you may be thinking in this scenario is if it breaks through its support line, it could continue to go down in price. So you want to set a stop loss order in this scenario at $174. So if you press sell and again confirm the order type and the order details, once you press OK, this order will now be open for 90 days, and if at any point during regular market hours it hits $174 or below, it will immediately send a market order for execution. On the opposite side, let's say you identify a resistance line of around $203. What you may be saying in this scenario is if Tesla goes up in price and breaks its resistance line, then you want to buy at the market price because you think once it breaks that resistance line, it's just going to continue to go upwards. So in this scenario, what you may be thinking of is doing a buy stop order. So you can set, again, the type as a stop market, make sure your symbol is correct, and choose the quantity. And then your trigger price in this scenario, again, would be $203. Once you press buy and confirmed your order details again and hit OK, this order means that any time during regular trading hours Tesla trades at or above $203, your stop order would be triggered and it would immediately send a market order ready for execution. These stop orders are prone to gap up or downs in the stock's market price. And this could be a good time to transition to detailing stop limit orders, which is an order type that combines the characteristics of both the stop and limit orders. It is, again, initially triggered at a predetermined stop price, but when that price is met, a limit order is sent for execution opposed to a market order. This, again, only guarantees execution at your specified limit price or better after being triggered. So let's revisit the scenario where we originally set a stop order, a sell stop order at $174. This order type is prone to gap down scenarios because if you have a good till canceled order, it is possible, or let's say that Tesla has some bad news overnight and it drops significantly overnight between sessions. Let's say it's set to open a following trading day at $160. With your original sell stop order, once the market opens, it would trigger a market order and you would get sold out of your Tesla share much closer to $160 than you possibly intended with your original $174 sell stop order. So how stop limits can come into play here is you could choose to set your trigger price at $174 as we initially did, but with a sell stop limit, you're also choosing a second price in your order type. And maybe you're saying once your original stop price is triggered, the least you're willing to accept to sell your Tesla share at is $172. So again, you're setting two different prices in this order type. And once you press sell and again confirm your order details, you could press OK, send that to market. And again, what this says is during regular trading hours, if Tesla ever drops to $174 or lower, I want to send an order to market to sell one share of Tesla, but the least I'm willing to accept is $172. If in this scenario Tesla gaps down, let's say to $160, this order would just be a pending open order and would not be executed in that scenario. So again, stop limit orders can be an alternative to stop orders if execution price is at least somewhat more important to you than guaranteed execution. And the final order types we are going to learn more about today are trailing stop and trailing stop limit orders. These order types on the sell side could allow you to protect your position while still giving it some room to grow. Unlike a standard stop order, which is set at a fixed price, a trailing stop moves with the market price, maintaining a specified distance or trail. The advantage here is as the stock price increases, the trailing stop price adjusts upward as well, so that if the stock reverses direction, the new stop level remains locked in. A trailing stop buy order could allow investors to purchase a stock during a reversal and on an uptrend by automatically adjusting the buy price as the market price decreases. This could allow investors to secure a lower entry point without constantly monitoring the stock's price movements. However, there are cons to this order type, particularly in volatile markets. The trailing stop order can lead to a trade being executed at an undesirable time due to shorter term fluctuations or gaps, and that may not reflect the stock's overall trend. So let's look at NVIDIA in this scenario here. Again, we're looking at trailing stop market orders first. And once you chose that order type, you would be able to choose a trailing type as either a ratio or a percentage or an amount. And let's say we wanted to set a trailing amount of $50. So for this example, again, we'll say that we set that trailing amount when NVIDIA was trading at $875. As long as NVIDIA does not drop by $50, so $825 right off the bat, then it's going to follow any uptrend that NVIDIA has and create new high watermarks to base that new trailing stop amount off of. So if NVIDIA goes from $875 to $900, that new trailing amount, that stop price would be at $850. If it went to $950, the trailing stop amount would go to $900. And again, setting new high watermarks along the way here. If the high of NVIDIA was $974 without this order ever being stopped out, then the stop price would have risen to $924. And if a reversal happened at that point, and NVIDIA fell to $924, then a stop order would have been triggered and a market order would have been sent for execution. So again, this order type could give your position room to grow while still having an essence of protection as well. And finally, similar to previous order types we discussed, trailing stop limit orders combine the features of a trailing stop order with those of a limit order. On a sell trailing stop, it not only follows the price up, but also specifies a limit or a spread on the sell price to ensure that the order executes only at a price you're comfortable with. So the trailing stop price could rise with the market price and stay constant if it reverses downwards. If the market price then meets the stop price, a limit order will automatically be submitted at the market price when it is triggered, minus your specified spread amount. The pro here is that you have the flexibility of the trailing feature to keep up with the stock price movements, alongside the control over the execution price provided by the limit order element. This ensures that your order will not be filled at a price that's unexpectedly lower than the market price. The con, however, is the potential for the order to not execute at all. If the stock's price moves swiftly and skips past your limit price without executing, you might miss the opportunity to sell, especially in a fast-moving market. Similar to a trailing stop market order, you will be able to choose either a ratio or amount for your trailing amount, but you will also be able to choose a spread. So if your stock continues to move upwards but then reverses course, once it reverses course by your trailing amount, a limit order will be submitted at the market price at the time the stop is triggered minus your specified spread amount. So again, this order type gives you not only the dynamic trailing amount, but more of a say in execution price if that is what is most important to you. To wrap this up, hopefully we now understand more about how different order types can impact our trading strategy. Again, today was not just about learning, but really getting to know how to put some of these strategies into play, especially on Moomoo's desktop platform. Thanks again for joining and diving into this with me. Really looking forward to learning more and working towards our financial goals together.
Well, thank you, Jacob. We appreciate your time, energy, and knowledge that you shared with us today. I do hope that everyone who has participated in today's presentation has gained some new knowledge or gotten a better understanding of how to use the Moomoo desktop platform. Now, some quick promotions that are going on that are currently running until the end of March. So yes, it is the end of this month. We do have a special welcome bonus for you. This welcome bonus not only includes up to 15 free stocks, but also you are eligible to get a 5.1% based APY on your uninvested cash and receive an additional 3% APY booster. For our existing clients, thank you so much for having Moomoo be part of your investing journey. We do greatly appreciate you. And we wanted to let you know that there is still a great transfer bonus that is happening. Again, it does end at the end of this month. If you do plan on taking advantage of any of our current promotions, please make sure you do start that process soon and give yourself enough time for the accounts and transfers to settle. And that way you can be eligible for them. Click those links though that just popped up on the side to ensure that you do understand the terms and conditions for each of our current promotions. Thank you again so much for joining us today and letting Moomoo be part of your day as well as investing journey. Remember to click that link to the webinar survey so that we can receive your feedback on how best to build out this trading trek series to meet your needs and where you are in your trading journey. If you have more questions or we just didn't get to yours today, please do contact us at cs@us.moomoo.com. With that, have a wonderful day and we'll see you next time.